Over the years, I've learned that the most dangerous assumption investors make is thinking that what's been true in the past will always be true in the future. People ask me all the time, are stocks a smart investment? My answer is, it depends, but not in the way you think. Because truthfully, most people don't really understand what they're investing in. They just see the upward line on a chart and think that's intelligence, but that's not investing, that's just following momentum. If you don't understand the system you're in, the cycles, the incentives, the drivers of growth and contraction, then you're not investing, you're gambling. Most people assume that investing in stocks is always a smart move. They've heard it over and over again, buy and hold. The market always goes up, time in the market beats timing the market. And while those principles hold some truth in the long term, they can be dangerously misleading if misunderstood or applied blindly. What most people fail to realize is that when you invest matters just as much, sometimes more than what you invest in. Everything moves in cycles. Economies expand and contract. Credit grows and then tightens. Governments intervene and then they pull back. These cycles affect markets in powerful ways, yet most investors either ignore them or don't understand them at all. They treat the market like a straight line, when in reality, it's more like a wave. If you're surfing, the wave can carry you if you're in the right position. But if you're off balance or facing the wrong direction, that same wave will crash right over you. Take the early 2000s. In the heat of the tech boom, people were piling into stocks at inflated valuations. It felt smart at the time because everyone else was doing it. The narrative was strong. This is the future. These companies will change everything. And some did, but many didn't. When the bubble burst, investors who thought they were making smart decisions were left with huge losses, and it took years to recover. The same story repeated itself during the 2008 financial crisis. Leading up to it, the markets were climbing, housing was booming, debt was cheap, everyone felt secure. But under the surface, risks were accumulating. People weren't paying attention to the cycle, they were just reacting to the present moment, assuming it would last forever. Then reality hit hard, and those who hadn't prepared or diversified suffered the most. Timing the market perfectly is impossible, but ignoring timing altogether is equally dangerous. Smart investing isn't about guessing the exact top or bottom. It's about understanding where you are in the broader cycle. Are interest rates rising or falling? Is debt expanding or contracting? Are valuations high or low relative to earnings, growth, and real economic activity? If you're buying stocks at a time when everything is priced for perfection, when future earnings are already fully priced in and the economy is running hot, you need to understand that you're not getting in at the same price or opportunity as someone who invested after a crash. And more importantly, you should be thinking about what comes next, not what just happened. That's why it's critical to study history. Markets move not because of charts or patterns, but because of human behavior, policy shifts, and structural changes in the economy. When you understand those, you start to see the signs of a turning point. You see when optimism is turning into euphoria and when pessimism is giving way to opportunity. That insight gives you perspective, and perspective leads to better decisions. It's also why diversification is essential. If you don't know exactly where you are in the cycle, and even the best investors are often uncertain, then you want to hold a range of assets that will perform differently depending on what happens. Stocks are just one part of that equation. Bonds, commodities, inflation-protected assets, even cash, they all play a role. Betting everything on one asset class in one country at one moment in time is not intelligent investing. It's blind risk-taking. We live in a time of massive structural shifts, high debt levels, changing monetary policy, global geopolitical tensions, technological disruption. These forces affect the timing and impact of economic cycles in ways that we can't always predict with precision. But we can prepare. We can stay balanced. We can recognize that stocks aren't always a good buy just because they've done well in the past. If you're investing today, ask yourself, are you doing it because the fundamentals make sense? Or are you reacting to momentum, news headlines, and the fear of missing out? Because at the end of the day, the market doesn't care about your feelings or beliefs. It cares about capital flows, risk and reward. Understanding timing and cycles doesn't mean abandoning stocks. It means being wise about how you use them. It means recognizing that patience and awareness often outperform speed and confidence. Smart investing is never about doing what feels good. It's about doing what's right, even when it's hard. That includes understanding that there are moments when stocks are a fantastic investment and moments when they're not. The difference is subtle, but over time, it's everything. Most investors don't realize how fragile their portfolios actually are. They think they're diversified because they hold a bunch of different stocks, maybe some large caps, some small caps, a few international names, and a handful of ETFs. But if all of those are correlated to the same economic forces, then they're not really diversified. They're just concentrated in disguise. And concentration, especially when paired with blind optimism, is a recipe for disaster. The biggest mistake people make is assuming that what worked yesterday will continue working tomorrow, that the trends that made them money in the past will keep repeating. That's not diversification, that's hope. And hope isn't a strategy. You can't afford to be guided by narratives, headlines, or popular opinion. You have to look at the mechanics, how the world actually works. The future doesn't look like the past. The world is changing rapidly. Debt levels are higher than ever. Inflation is unpredictable. Geopolitics are more fragmented, and technology is shifting everything. Relying on a single strategy or even a single asset class in this environment is dangerous. And yet, most investors remain highly exposed to one risk, the assumption that equity markets will always deliver. There's a reason why almost every great financial blow-up has one thing in common: overconfidence in a single idea. The tech bubble was driven by blind belief in innovation. The housing crisis was driven by blind belief in real estate. Each time, investors convinced themselves that the rules had changed, that they didn't need to prepare for the downside, that everything would keep going up, until it didn't. Diversification is the only free lunch in investing, but real diversification requires more than just adding assets. It requires combining uncorrelated assets that behave differently in different environments. That means owning things that perform well when growth is strong and inflation is low, and also things that perform when growth slows or inflation rises. You need exposure to different countries, different currencies, different economic cycles. Most investors are concentrated in one country's stock market, usually their own. That's a bias, home country bias, but the world doesn't revolve around one economy. If your entire financial future is tied to the performance of one market under one set of economic conditions, you're exposed. You might not feel it now, but when the winds shift, it'll hit you. A good portfolio is like a well-built machine. It doesn't rely on everything going right. It's designed to weather different storms. It doesn't assume what's next. It prepares for what could be. The best investors in the world don't make big bets on being right. They build strategies that can perform even when they're wrong. Because the truth is, nobody knows the future. Nobody. The economy is a complex, dynamic system driven by millions of variables. Central banks make policy decisions based on lagging data. Governments respond to crises. Markets react emotionally. The environment shifts constantly. If you're not diversified, you're just guessing. And if you're guessing, sooner or later, you're going to guess wrong. Blind optimism is seductive. It's easy to believe in a clean story, the kind that says stocks always go up, or that you only need to buy index funds and wait. But that story breaks down in the face of real volatility. Just ask the people who retired in 2008, or those who bought the top of the tech bubble in 2000. If you buy right now, 2%. The people who buy the top of the tech bubble, in 2000. And then wait, the tech bubble peaked. The tech bubble peaked in 2000. And then wait, the tech bubble, they didn't think they were being reckless. They thought they were being smart, but they were unprepared. That's the cost of not diversifying properly. You may not feel it every day, but the risk is always there, like a leak in the roof that only shows itself in the storm. And storms always come. They're part of the cycle. The key is to be ready when they do. Diversification isn't exciting. It won't make you rich overnight, but it's what protects you from ruin. It's what keeps you in the game long enough for your smart decisions to compound. Without it, even the best ideas can fail. With it, even average decisions can produce extraordinary results over time. If you're investing for the long run, you don't just want upside, you want resilience. And resilience comes from balance. It comes from spreading your risk across different outcomes, different systems, and different assumptions. It's not about being pessimistic. It's about being realistic. In a world where so much is uncertain, the most intelligent thing you can do is build a portfolio that doesn't need to be exactly right to still succeed. That's what real diversification looks like. And that's what keeps blind optimism from becoming your blind spot. The most dangerous risks are the ones you don't see coming. That's what catches people off guard. That's what wipes them out. It's easy to plan for what you understand. It's much harder to protect yourself from what you don't even realize is a threat. And yet, that's where the real damage happens, not from the obvious, but from the hidden. Most investors focus on what's in front of them. They look at charts, trends, earnings reports. They listen to financial news, track inflation numbers, follow interest rate decisions. But the big losses don't usually come from things that are already priced in. They come from the surprises, the shifts no one expected, the second order effects no one prepared for. History shows us this over and over again. In 2007, the economy looked stable on the surface. Housing prices were high, employment was strong, the market was booming, but underneath it all, there was a massive buildup of leverage. Complex financial instruments, subprime loans, and opaque risks were woven deep into the system. Most people didn't know, even professionals didn't fully understand what they were holding. And when the unraveling began, it was fast and brutal, not because of what people knew, but because of what they didn't. The same pattern appears across time and geography. And whatever poverty does, it takes out this Japan in the late 80s, the dot-com crash, the European debt crisis. Each time, the problem wasn't just bad decisions. It was hidden risks accumulating slowly, then exploding suddenly. And each time, most investors were blindsided because they weren't looking at the whole picture. They were assuming stability because that's all they had experienced recently. One of the most important things you can do as an investor is acknowledge what you don't know, because there's always more that you don't know than what you do. The world is too complex to fully understand. Markets are driven by economic policies, human psychology, geopolitical moves, technological change, all interacting in real time. The moment you think you've got it figured out, you're probably already vulnerable. So the question becomes, how do you protect yourself from the unknown? The answer is not to predict better. It's to build a strategy that doesn't depend on being right all the time. You need to create a portfolio that can absorb shocks, one that's robust in different environments, including the ones you didn't see coming. That's why diversification is not just a buzzword. It's a necessity, not just across sectors or companies, but across asset classes, regions, currencies, and economic outcomes. It also means understanding the difference between what's probable and what's possible. A lot of people only prepare for the most likely outcome. That's a mistake, because what's unlikely is often what causes the most damage when it happens. Look at black swan events. Look at regime changes. Look at the COVID-19 pandemic. Most people didn't plan for those things, not because they were impossible, but because they seemed unlikely. And when they hit, the systems that weren't prepared cracked wide open. This is why humility is so important in investing, not just as a mindset, but as a discipline. If you believe that your model is perfect, that your assumptions are solid, and that your projections are accurate, then you're setting yourself up for failure. The best investors are the ones who say, I could be wrong. And then they structure their portfolios in a way that reflects that reality. That's also why stress testing is critical. You have to think through scenarios, good, bad, and ugly. What happens if interest rates spike unexpectedly? What if inflation stays high for longer than expected? What if political instability hits your region of investment? You don't need to predict these events with precision, but you do need to understand how exposed you are if they occur. People assume that risk comes from volatility, but that's not really true. Volatility is just movement. Risk is permanent loss, and permanent loss usually comes from being overconfident, underdiversified, and unprepared. The goal isn't to eliminate risk. That's impossible. The goal is to identify it, respect it, and manage it, especially the kind of risk that doesn't show up until it's too late, the risk that sits quietly under the surface while everything looks fine. In the end, your greatest exposure is not from what you think might go wrong, it's from what you haven't even considered. That's why the smartest investors aren't the ones with the best forecasts. They're the ones who build resilience into their approach, who design systems that can endure surprises. Because it's not what you know that will hurt you most, it's what you don't. Most people underestimate the power of time. They want fast results, immediate validation. They chase short-term gains, move from one hot stock to the next, always searching for the next big thing. But investing doesn't work like that, not sustainably. The real rewards come not from quick wins, but from staying in the game long enough for your decisions to compound. And that takes discipline. Discipline means more than just holding on. It means sticking to a thoughtful strategy, even when it feels uncomfortable, especially when it feels uncomfortable, because markets don't rise in straight lines. They move through cycles, expansions, contractions, recoveries, bubbles, crashes. And during those times, your discipline is tested, not once, but over and over again. People forget that volatility is normal. It's part of the process. You can't participate in the upside without enduring the downside. Every period of sustained growth has been interrupted by periods of pain. That's just how markets function. So look at any long-term chart and you'll see jagged edges, not smooth curves. The long-term trend is up, but the path is anything but easy. The problem is most investors react emotionally. When markets drop, they panic. When markets soar, they get greedy. They let their fears and desires override logic. And the result is always the same. They buy high and sell low. Over time, that behavior destroys return. Not because the assets were bad, but because the behavior was. Discipline is what separates those who succeed over decades from those who merely chase noise. It's the ability to stay grounded when others lose their heads, to follow a process rather than a prediction, to accept that there will be pain, but trust that the design of the system, if done thoughtfully, will deliver in the long run. The long term still works, but only if you respect the nature of time. Time punishes the impulsive and rewards the patient, but patience isn't passive. It requires active choice. It means resisting the urge to tinker, to chase, to overreact. It means constantly reminding yourself why your strategy exists in the first place and sticking to it even when the world screams otherwise. That doesn't mean doing nothing. It means doing the right things consistently. Rebalancing, managing risk, adjusting to structural changes when necessary, but not based on noise. It means understanding your own tendencies, your blind spots, and designing systems that help you avoid them. Because in investing, the enemy isn't the market, it's often yourself. There's also a misunderstanding about what long-term investing really is. It's not about picking a few stocks and forgetting about them. It's about building a well-diversified portfolio that can perform in a variety of environments. It's about accepting that you won't always win, but if you manage your risks and stay disciplined, you can win enough. And it's about understanding the underlying forces that move the world: productivity growth, inflation, interest rates, monetary policy, innovation, demographic shifts. These forces don't change overnight. They evolve over years, sometimes decades. But when they do, they shape markets in profound ways. If you're paying attention, and if you have the discipline to stay the course through the noise, you'll be positioned to benefit from those shifts, not be blindsided by them. The beauty of the long term is that it gives you time for compounding to work. Compounding is not just about returns. It's about decision quality compounded over time. Small, smart choices made consistently outperform big bets made inconsistently. That's a principle that applies not just in investing, but in life. But it only works if you give it the space to operate. That's the part most people don't appreciate. They want the upside without the waiting. They want the destination without the journey. And in trying to shortcut the process, they sabotage their own success. So yes, the long term still works, but not by default. It works if you're disciplined, if you understand your environment, if you manage your risks, if you stay rational when others are irrational, if you build a system that protects you from your own impulses, and if you give your strategy time to bear fruit. Success in investing doesn't come from brilliance. It comes from consistency, from showing up again and again, even when it's hard, especially when it's hard, because those are the moments when long-term discipline gets forged and when real wealth gets built. The most consistent and costly mistakes in investing are not analytical. They're emotional. People don't lose money because they lack intelligence. They lose money because they can't control their emotions. They get excited when prices rise and afraid when prices fall. They chase performance and flee at the worst possible time. This emotional cycle repeats itself again and again. And it's the reason why average investors underperform even the assets they hold. Investing requires decision-making under uncertainty. That uncertainty triggers fear, greed, and ego, three of the most dangerous forces for any investor. The moment you allow those emotions to drive your thinking, you start reacting instead of reasoning. And when you react emotionally to markets, you become predictable. Markets exploit predictable behavior. Think about the patterns we've seen throughout history. In every major bubble, people convinced themselves that this time was different, that the old rules didn't apply. They weren't thinking clearly. They were following emotion. They saw others getting rich and they didn't want to miss out. They bought at the top because it felt good. Then when the bubble burst, that same emotional wiring kicked in. But this time, with fear, they sold at the bottom to avoid more pain. The result, buy high, sell low. The exact opposite of what works. This emotional behavior isn't a fluke. It's wired into human psychology. We're not built to be good investors by nature. Our instincts evolved for survival, not for managing complex financial systems. We're wired to overreact to threats, to follow the herd, to seek comfort in consensus. But the market rewards the opposite. It rewards those who can think independently, stay calm in the storm, and do what feels uncomfortable when it's necessary. One of the hardest things to do is to remain rational in the face of emotional extremes. When markets are collapsing, everything in you wants to take action, to do something. That urge comes from a desire to relieve uncertainty. But good investing often requires sitting still, doing nothing when others are panicking. That doesn't feel good, but that's what discipline is. Discipline isn't about removing emotions, it's about not being ruled by them. You can feel fear, you can feel greed, but you have to act based on logic, not feelings. That's why successful investing requires a system, a set of principles you follow regardless of the emotional climate. If you don't have a system, you will be pulled into the emotional tides of the market just like everyone else. One of the best tools you can use is reflection. Study your own past behavior. Look at when you made your worst decisions. Chances are they happened during periods of emotional intensity, either euphoric highs or terrifying lows. Once you see the pattern, you can begin to change it, but you can't fix what you don't understand. Self-awareness is a key part of becoming a better investor. It also helps to remember that the market doesn't care about your feelings. It doesn't respond to your hopes or fears. It doesn't reward confidence. It rewards being right. And being right requires staying grounded in reality, not in emotion. That means focusing on fundamentals, understanding cycles, managing risk, and thinking in probabilities, not certainties. Another emotional trap is ego. People tie their identity to their positions. They want to be right more than they want to succeed. They double down on losing trades because they can't admit they were wrong. They ignore new information because it contradicts their view. That kind of rigidity is toxic in a world that's constantly changing. The best investors are humble. They update their views when the facts change. They accept being wrong as part of the process. You also have to prepare in advance. The time to make good decisions is before the emotions hit. That means building a strategy ahead of time, stress testing it, and committing to it. When volatility comes, and it always does, you can fall back on the plan. If you wait until you're in the storm to decide what to do, the storm will decide for you. In the end, investing is less about brilliance and more about behavior. You don't need to predict the future. You need to manage yourself in the present. That's where the edge is. Not in information, but in execution. The ability to stay calm, rational, and consistent when others can't is what sets great investors apart. The market is a reflection of collective emotion. Your job is to not get swept up in it, because the moment you do, you're no longer an investor, you're a participant in a psychological experiment. And history has shown that those who let emotion lead almost always end up on the wrong side of the trade. So are stocks actually a smart investment? They can be, but only if you approach them with humility, patience, and knowledge. The market doesn't care about your emotions. It doesn't reward hope. It rewards disciplined thinking, long-term strategy, and diversification across uncorrelated bets. If you treat stocks like a magic trick that will save you from your financial worries, you'll be disappointed. But if you treat them as one piece of a balanced system grounded in real understanding, then yes, over time, stocks can be smart, because smart isn't about chasing returns. Smart is about surviving the storm and still being in the game when the sun comes back out. That's the goal. And that's how you win